The most valuable thing in the global economy is not oil. It's not gold. It's not even money. It's the belief that tomorrow will look enough like today that the system keeps working. Because the moment the belief cracks, money turns into paper, numbers turn into fiction, and power moves very fast. And almost nobody talks about this directly. Right now, trust is carrying more weight than at any other point in modern economic history. Not because systems are stronger, but because they're thinner. Here's why that matters. For most of human history, value was physical. Land, grain, livestock, metal you could hold. If you wanted to trust something, you touched it. Modern money broke that rule. Your salary isn't backed by gold. Your bank balance isn't sitting in a vault. Even cash itself is a promise printed on cotton paper. What makes it work isn't substance. It's agreement. Agreement that your employer will pay you. Agreement that your bank will honor withdrawals. Agreement that the government won't destroy the currency to solve its own problems. Money works because we all pretend, together, that it's stable. That pretense used to be reinforced by constraints. Gold standards.
What's this?
Fixed exchange rates. Limited credit creation. They weren't perfect, but they forced discipline. Those constraints are gone. Today, money is created largely through trust-based mechanisms. Banks create money when they issue loans. Governments create money when they run deficits. Central banks create money when markets begin to wobble. None of this works if people stop believing the numbers will hold. And belief is doing a lot of heavy lifting right now. Consider this. If every bank customer tried to withdraw their money at once, the system would collapse. Not hypothetically. Literally, banks don't have your money. They have a fraction of it and a lot of promises. This isn't a flaw, it's the design. The system assumes trust as a constant. It assumes panic won't spread. It assumes confidence holds. When it does, everything looks stable. When it doesn't, the math gets ugly fast. That's why central banks obsess over something that sounds vague but controls everything. Expectation. Inflation expectations, market expectations, consumer confidence. Because once trust breaks, no interest rate is high enough and no bailout is large enough to put it back together quickly. We've seen this movie before. In 2008, the financial system didn't collapse because money disappeared. It collapsed because institutions stopped trusting each other overnight. Banks didn't know which balance sheets were real, which assets were toxic, which counterparties were solvent. So, they froze. Credit stopped moving. Markets seized. Government stepped in, not to save banks, but to restore trust. Trillions were created, guaranteed, insured, not because the money existed, but because belief had to be rebuilt immediately. That response worked, but it changed the system permanently. From that moment on, markets learned something dangerous. When trust breaks, authorities will step in. When risk grows too large, it will be socialized. When losses threaten confidence, rules become flexible. This created a strange new equilibrium. Markets price in rescue. Investors assume liquidity. Debt grows because trust has a backstop. But that backstop is also built on trust. Trust that governments can borrow indefinitely. Trust that central banks can control outcomes. Trust that inflation can be managed without political consequences. Here's the uncomfortable math. Global debt is now far larger than global income. Not slightly larger. Structurally larger. Debt only works if future trust grows faster than current obligation. That means the system isn't just betting on productivity. It's betting on belief that future workers will accept the rules. Belief that savers won't revolt. Belief that currencies won't fracture under pressure. And belief is fragile. Public narratives make this sound cleaner than it is. You'll hear that markets are pricing in growth. That deficits are sustainable. That inflation is transitory or manageable. Those words aren't lies. They're softeners. Underneath them is a simple reality. The global economy now runs on confidence more than collateral. Look at sovereign bonds. Governments borrow trillions at low interest rates, not because they're risk-free, but because everyone believes they will be honored. There is no global enforcement mechanism, no collateral pool, no emergency court. Just trust. When that trust is strong, borrowing is cheap. When it weakens, yields spike, currencies wobble, and political stability gets tested. This is why market reactions feel sudden. Trust doesn't erode linearly. It breaks in chunks. One bad auction, one policy mistake, one unexpected shock. Then suddenly, Everyone recalculates at once. We call these moments crises, but they're really trust repricings. And each time they happen, the system becomes more centralized, more guarantees, more intervention, more reliance on authority to stabilize belief, which creates another quiet irony. The more trust we outsource to institutions, the more fragile the system becomes if those institutions lose credibility. That's why modern finance is obsessed with signaling, forward guidance, press conferences, carefully chosen language. Central banks don't just manage money, they manage stories, because a well-timed sentence can move trillions faster than a policy change. This wasn't always true. In older systems, constraints spoke louder than words. Now words are the constraint, and that creates a strange tension. Official messaging says stability. Market behavior reveals anxiety. Asset prices rise not because fundamentals improve, but because trust has nowhere else to go. Cash loses value. Bonds feel crowded. Speculation fills the gap, not out of greed, but out of faith management. People aren't chasing returns. They're trying to stay inside the system that still feels trusted. This is where the absurdity creeps in. The more uncertain the future becomes, the more valuable trust is. And the more valuable trust is, the more incentive there is to stretch it. Promises get longer, timelines get pushed, risks get reframed, until eventually trust isn't supporting the system, it is the system. That works until it doesn't. History doesn't end with collapse. It ends with adjustment. Currencies reset, debt restructures, power rebalances. Not because people suddenly understand economics, but because trust relocates from one institution to another, from one currency to another, from one narrative to a new one that feels more believable. The danger today isn't that trust disappears. It's that it becomes too concentrated. When too much depends on a few institutions, a few currencies, a few decision makers, the cost of failure rises exponentially, which brings us back to the uncomfortable truth. Money is no longer the foundation of the system. Trust is, and trust is emotional, political, and deeply human. It doesn't obey spreadsheets. It doesn't respect models, and once lost, it rarely returns in the same form. So the real question isn't whether the system can keep functioning, it's this: what happens when the world starts trusting something else instead?